Let's get more color on the Fed's newly recalibrated policy from a former official, former Minneapolis Fed President Narayana Kocherlakota, now professor of economics at the University of Rochester, and joins us now. I don't know, were you surprised by this? I find it surprising and also hard to figure out what comes next as a result. What about you?
Yeah, Sarah, thanks for having me on. I was surprised. And the reason I was surprised is that historically the Fed has not moved downward by 50 basis points unless they see a big risk to the economy. And that was something that Chair Powell went into great lengths, I thought, yesterday to take off the table. There isn't that kind of risk. So that raises the question, what's going to come next, is exactly as you asked. And it seems to put 50 basis points in play at every meeting now. Because if you're willing to move 50 in September, why aren't you willing to move 50 again in November or December?
That's not what the dots showed.
But I think the dots are mistaken in the following sense. I think the Fed has underestimated to what extent they've communicated that they're using what I would call a new language. The old language was when we want to move rates down during normal times, we're going to move by 25. We might wait a meeting. Now the new language is 25, 50, both are in play. And maybe, hey, why not 75?
But they also said that they're data dependent. And I wonder where you think the data is pointing, because that's also up for interpretation. We've made a ton of progress on inflation. You could argue that's why the need for recalibration. We've softened on jobs, but there are questions as to really how much. And the consumer seems to be holding up OK.
I think the situation is one where it's very easy to see why the Fed thought this was the right time to cut rates. And, for what it's worth, I agreed with that completely. What is much harder to understand is why, what in the data calls out for a 50 basis point cut. And I don't see that in the labor market data, and I don't see it in the inflation data. I think there's enough stickiness still with inflation to say, let's go slowly. I think there's enough, as the chairman emphasized yesterday, boy, the labor markets are still very strong by historical standards. So I think it's very difficult to understand the 50 basis point call as opposed to 25. I think cutting it made a total sense.
But now that they've done it, you think they will do it? They will continue to do 50?
I think they're going to be forced to do 50. I think they're sitting there right now thinking, no, we're going to do 50 over the next two meetings. I think they're going to find that very hard. I think that markets are going to be forcing them to move faster through their expectations. They're going to be worried about disappointing markets. And I think observers of the Fed will be calling on them to move more rapidly.
What's the risk? What's the risk of them if history shows that this is too aggressive or that they were a little too excited here?
So I think the risk here is on the inflation front, that maybe the battle isn't won yet. But really right now, Sarah, I think the challenge here is that the Fed has introduced a lot of volatility into people's expectations of a monetary policy. People like myself who follow the Fed for a long time are now left wondering what's going to come next in terms of how are they going to attack the problems before them. And I think that uncertainty is not, when uncertainty leads to upward movements when we see markets go up, that seems good. But overall volatility is a bad thing.
Really great to have you here today. Valuable to analyze what we got from the Fed. Former Minneapolis Fed President Narayana Kocherlakota. Thank you.